Welcome back. I hope everyone has been doing well recently. Today, I will be talking about my newest investment with a target of it realizing its value by, let's call it mid 2023. And this is a value play, but there's also a hint of some popular topics around markets, and those being graphene, electric vehicles, but mainly I'm going to talk about why value and how I see it realizing the missing value. Disclosure, as always, I own it. I bought a partial position very recently, but it does have risk associated with it and more risk than perhaps your average investment, so it might not be right for many. Now, I'm sure many of you saw the subtitle on the first slide of this video and thought, DV, are you okay there, buddy? Have you lost your mind? Um, and why is that? Well, because it's a fair question. I mean, in terms of deep value, electric vehicles don't exactly seem like the type of thing. They talk about growth versus value. I mean, that's always a thing. And despite what Cathie Wood said recently, to most people, electric vehicles and that type of thing doesn't exactly fit in deep value. And then we go to graphene. It's kind of an unproven technology. It might be fantastic. It might be nothing. And neither of these kind of sound like what you talk about on the channel. And so that's fair pushback, but let me explain. So what am I allowed to discuss on this channel? Allowed in quotations, I guess. Undervalued companies, industries that nobody cares about, cyclical type things. Can I talk about those, Mr. or Mrs. Critical Viewer? So the company I'm going to be discussing today is Martinrea International. Their metrics make them look like a traditional value stock. Trailing price to earnings is around 10, trailing EV to EBITDA around 6, including 2.5 turns of debt, and this is something I'll address later, but the main wart on the company, if you will. 0.7 to 0.75 times book, not ridiculous there. And they are a small cap, and I'll get to more of why this is relevant later, but at about 850 million Canadian in market cap with nearly twice that as their enterprise value. So why am I making this investment now? Well, as I said before, and probably will clarify more later, I'm only starting. So I took an initial position now. Why? Well, the first reason is I believe that tax loss selling is near its peak. And this is definitely a potential candidate for that because it has gone down all year. Why? Because of the carnage, because of the problems with the chips. And I believe that enough of that has been priced into the auto sector and particularly the auto parts sector. They've had a tough year all around, really. And which leads to three, I believe there are strong fundamentals in the auto sector because of this disruption, these troubles that they've had. I believe that there's strong fundamentals that support years to come of strong earnings in the sector, which leads to number 4, earnings acceleration. I believe that in the coming 18 months or whatever, approximately, we will be seeing earnings accelerate for this company because it, like I said, been through this a few times already. I don't think the chip shortage will last forever. I don't think supply chains will remain broken forever. So I think as they do, there's going to be efficiencies and things are going to get better. Don't know exactly when the bottom is. And so that's why I'm taking slow steps into this. Well, on the flip side, why not now? Because it's never a no-brainer to make an investment, and if it is, it probably isn't. And so looking at the reasons why not to buy it now is important, and I can name a few, honestly. If the supply chain remains disrupted and the semiconductor shortage keeps going or gets worse for the auto sector, well, then it will take longer to recover, and it could be negative for this because it'll hurt. As I'll get to later, the leverage is not good for that. If globally we head for a severe recession, significant recession, it'll be bad. If the Fed panics on inflation and hikes 17 times next year, it would be bad. If we see persistent stagflation or severe deflation, it won't be ideal. I'm also not convinced that the fourth quarter will be fantastic. We've seen peers kind of say, we think the future will be strong, but probably not Q4. So, and that was a few months ago. So the Q4 earnings might not be good, and the stock might take a hit after. And lastly, I mean, in terms of the generic, why not make this investment now? If the market continues deciding, well, all cyclicals suck, so we're going to sell off all cyclicals because whatever macro factors lead to that, it's unlikely that the stock will do too well, even if the sector strengthens into a broadly weakening cyclicals market. And that's just kind of how the market works. So I'm sure everyone is well familiar with the chip shortage. Heard all about it, heard all about the supply chain, so I'm not going to stress too much about that. But I would say that if we look at some of the effects that that has had and think about what would cause them to reverse, it seems to me that the place that stands to disproportionately most benefit would be parts for new vehicles. Now, why that is because if we look at many places, what we see is big drawdowns in auto inventories. And, there's strong demand and producers not being able to complete the vehicles. And so if we think about it, that a drawdown in inventory doesn't necessarily hurt the people making the cars because they don't want to have a lot of inventory on their lots. They want to build and sell immediately. Now, maybe their sales will be hurt a bit, but the strong demand filters through, and if as long as nobody else has an inventory, then it's not the end of the world. But who it does hurt is the people that make volume, which is the parts. And no, don't get me wrong, I think that the vehicle producers will do well also going forward as this recovers because, we've seen this big drawdown in inventory, big strong demand, and, that's this fall in inventory is not sustainable. And that leads to the next part, which also explains the same thesis. And that is used vehicle prices don't normally do what they're doing in terms of they don't normally go parabolic, but they have. Why? Well, because people can't get new vehicles. And so that's why I think not only is there a strong market for new vehicles going forward, so I think that, the car companies will be strong, but I also think that and that will filter through to those that make the parts for said vehicles. So rewinding a few months to the most recent quarterly conference call, I think the first words that were said were that quarter sucked. Might have been something similar, but something along those lines. And yes, that's the company that I am investing in. Not because it sucked, because there are reasons why it sucked, and I think that they will end. So amid the higher launch costs, they had some other problems and were doubly hit. The problems were that in addition to being hit on volume, so hit on the top line, they were also hit on costs because due to the tight labor market, they were not able to downsize their capacity when the orders, when the volumes weren't going through. So they ended up losing money on the quarter, and also probably what the market also didn't like is that it brought them closer to the limit on their debt covenant. Now, at this point, you're probably saying, hang on, you were talking about electric vehicles and graphene. And that's true. Okay, I'll give you that now. So Martinrea makes parts for numerous vehicles and numerous companies, and they make frames, bodies, chassis, brake lines, all sorts of things. But that includes electric vehicles such as the Mach-E, the EV Hummer, the Model Y, and all sorts of other vehicles also. So that's the electric vehicles component, and I don't think it's unfair to say that. In addition to the next part, and that is, so Martinrea also has an investment in NanoExplore, which is a graphene company. Graphene is a early stage wonder material type thing. It's stronger than steel, but not viable at scale yet because there's not production, and they're still trying to figure out what it can be done and what it could be done, what it could be used for economically. So they have a investment in NanoExplore worth today, at today's price, about $220 million Canadian, or about a quarter of their market cap, or $2.70 a share of Martinrea. I don't believe they're getting value for that. I mean, in terms of, I don't believe the market is seeing that and thinking, okay, that's going to be good. But the other interesting part, and the other EV side of this, is that they have a joint venture with NanoExplore called VoltaXplore. And this is working on making graphene-enhanced batteries that could be used for potentially EVs or grid scale, but still in the early stage testing. Sounds optimistic, but they haven't really published results, so it's not something I'm going to be assigning any value to when I look at the valuation for the company. So before getting into what I think it's worth, I'm going to talk a little bit about some of the bull cases I've seen. Most bulls will look at the company and tell you it's cheap. You look at the earnings multiple, you look at the EBITDA multiple. Yeah. The thing is, alone, that doesn't really mean much. I mean, who's ever going to care about an auto parts company? I mean, maybe people will. Is this valuation stretched based on its historical norms? No. But would I sit on a company that is cheap based on just that and never going to, fix that? That's also something I wouldn't do. Most bulls won't mention that they have a fair bit of debt. And honestly, when I look at the company, that is the main issue, the obvious issue that I see, is the debt. Now, I believe they should be fine, and I believe that if you look at the insiders buying recently and a while back also, including a large holder that significantly increased their stake recently, I believe they think, as I do, that the company will be okay, and they see the problem, or the perceived problem, and don't think it will be a serious one. Because again, the company, even in their quarter that sucked, was EBITDA positive, and so should be able to do fine. Now, what I'm going to do is kind of lay out the case for why it should become uncheap, or why what is the impetus for the share price to approximately double from here, and why it's not just going to be like one day the price doubles. what's going to cause it? And I think it's pretty simple, honestly. Fix the chips, fix the stock. I believe that over the next 18 months that the semiconductor supply chain will significantly improve, especially when it comes to autos. And if we look out at what the forecast is for 2023 for the company, that has been, been the forecast for a while, and kind of similarly, they've reiterated it, and they think that it's going to happen, and seems to reason that if the supply chains get fixed, that it should happen. And that is for between 4.6 and 4.8 billion in sales for 2023. And, that would convert to, if assuming comparable margins, that would convert to record EBITDA and earnings. And what's more is I think that if we look at the history of the company, they've never really had all of their facilities kind of maxed out to the point where they would be if they achieve that. And so they would be full and probably the most efficient that they have been, or very close. And similarly, along the way, as they get to the better earnings, I think their balance sheet starts to look fine. Because if we look out at, what's a reasonable amount of, their balance sheet's not terrible today, for starters. But what's a reasonable amount of net debt to EBITDA? 1.5 times? Okay, well, I will put forward, and I'll show it in a second, that if they hit these targets in 2023, they don't even need to reduce debt because their balance sheet will look better because it will be a lower portion of earnings. And, once they get there, they have the ability to grow or return capital or what have you. So let's look at how meeting those targets would translate. Well, pre-pandemic, their EBITDA peaked at 460 million on 3.85 billion in revenue. So if they hit their target, that would be approximately 560 million in EBITDA. And so if we take, assume some goes to CapEx, some goes to capital return, then if the company trades closer to 4 times EV to EBITDA, remember it trades at 6 now, more of that is debt, but again, 4 times EV to EBITDA, which is historically not expensive. The debt be at 1.5 times at the target would be 840 million in debt, which is pretty close to where they're at now, which means 2.5 times EBITDA would be their market cap's portion. So 2.5 times 560 is 1.4 billion in market cap. And then we take, the 250 million in excess cash that I called from before. So the capital returns or whatever you use it for. And from there you get 1.65 billion approximately, or $20 a share. And again, this just looks at earnings multiple and does not think of anything from the joint venture. And again, I don't think it would be particularly expensive at that point because they would still be doing $7 per share of annual EBITDA. Now I'll show you where I kind of pulled these numbers from, looking at the last 10 years of EV to EBITDA and of, EBITDA. And so you can see that prior to this whole debacle, they were growing almost every year for a decade. And so I believe that's the type of company that this is. They can grow. They're not a bad company. And if we look at the multiples that they trade at, 7 times EBITDA is on the higher end, 4 is on the lower end. It's not the absolute lowest, but I think it's a reasonable point to look, especially because I think that the fundamentals are likely to remain strong for a while as inventory gets rebuilt in addition to kind of correcting for the under sales that have been seen in this year. Now, I'm sure a few of you are probably now thinking, wait a second, you said this, something very similar last year about Linamar. Well, what happened to that? What's wrong with Linamar? And so it's true. I did say, by the end of, I think it was this year, that Linamar would have or should double. Now, I'm not sure if we'll call that a win or a loss. It did more than double. It is not there now. So B minus? I don't know. I don't know how you grade that, but it did for a while. And I have also not sold a single share of Linamar. They did everything that they were supposed to. And, I was just liking this thesis and wanting to increase my leverage. And Linamar, in doing everything that I thought they would, they have taken their balance sheet from actually kind of similar to where Martinrea's currently is to net cash. And, if you're looking for more leverage to a thesis, you don't go with net cash. And I still have Linamar. I still think that if looking out a few years, if I'm right on this one, Linamar probably has 3 digits before the decimal in their share price. And so I'm not selling yet. I'm just kind of looking to add exposure. And so in a leveraged way. Now, if Linamar just did a $1 billion substantial issuer bid and levered themselves back up, I might be looking at adding there too. And honestly, am I convinced that this is necessarily a better risk reward than Linamar? No, but it is more leverage, and that's kind of what I was looking for at this point. And look, while having leverage is definitely a risk, and I've addressed that here, it does provide the potential for more upside on a similar style recovery. And you can see a little bit of the math here. I don't want to run through it in too much detail, but more risk, more reward. That's the concept. So far I have bought, as I said, a small position, and I'm prepared to buy more if it goes lower. I'm also cautious here because truthfully, I don't know what Q4 is going to look like, and it may well suck. And if it may well suck, then the stock might take another hit. So that is a very real short-term possibility. There's also the possibility that the supply chains keep struggling or get worse. And if that would happen, it would not surprise me to see the stock go lower. So that's why I'm not buying it all at once. What I think eventually happens is that the recovery of production, as I've gone through, it is problematically low, the inventory and the production. And so I believe that will get better and drive efficiencies and earnings growth for Martinrea. And despite everything, despite the bad year, despite the stock going down all year and all of the troubles that I believe are passing through, the stock is still trades below or around 10 times trailing earnings. And this is with production and inventory that both need to grow and efficiencies that will likely come with that. So I personally, if I were in charge and we do see the recovery that I think will happen, there's multiple options, of course, depending on the valuation of the equity, but I would delever a bit more and then crank out the capital returns. But if they keep at 1.5x what I believe earnings will be, that's fine too. I also don't know if the graphene battery venture is the next generation of batteries, the next big thing. I don't know if it's anything, but I believe that we'll see what happens. And, if this is something really big, that's why it is relevant that this thing is still a small cap. It's sub $1 billion market cap. So if this is the next big thing in batteries and it's become super attractive to someone, or the market loves it, or some SPAC wants to merge with the JV or something like that, it still has the potential for meaningful returns for the company based on this investment premise. Now, again, that could be nothing, and that wouldn't really affect any of the valuations that I looked at. And with that, I think I have gone on for long enough. So thank you everyone for watching. Remember, this is not investment advice, but I will add this to the model portfolio and keep track of how it goes. Hopefully it goes well, and hopefully everything goes well for all of you. Until next time, have a good one.